The line outside the bank starts forming before sunrise. No one is shouting yet, but the quiet is already wrong. Phones glow with unread messages while a printed notice is taped to the glass, explaining that systems are temporarily unavailable and normal operations will resume soon. Inside, the lights are on, the doors are locked, and the money that exists on screens can no longer be reached by the people who own it. This moment does not feel like collapse. It feels administrative. History does not record this as a warning, but this is usually where the story actually begins. Because when banks freeze, value does not disappear evenly. That distinction matters. The past 2 decades have trained savers and investors to think of value as something abstract and portable, something that can be moved instantly and accessed everywhere. That assumption only holds in stable systems. When access breaks before pricing does, the definition of value changes faster than most people expect. This is not a question about returns. It is a question about survival inside a malfunctioning financial system. In recent years, the idea of a bank freeze has drifted from the edges of imagination toward the center of policy planning. Payment rails are more centralized than they appear, settlement layers are more fragile than advertised, and liquidity depends on confidence that cannot be legislated back into existence. The surface narrative focuses on interest rates, balance sheets, or stress tests. The underlying reality is simpler. Modern finance is built on continuous motion, and freezes are moments when motion stops. This channel approaches these moments through financial forensics, studying past system failures to understand what survives, not what performs well, not what is praised in retrospect. What continues to function when the system itself stops cooperating? The promise here is narrow and deliberate. By the end of this analysis, the mechanics that determine what keeps value during bank freezes will be visible. Not as a list of assets, but as a hierarchy of access, control, and recognition. This is not about predicting the next crisis. It is about understanding the rules that quietly replace the old ones once a freeze begins. To get there, a mental framework is required. Think of systemic failure not as a single event, but as a sequence of constraints tightening around economic actors. First comes doubt about liquidity. Then come restrictions on movement. Finally comes a redefinition of what counts as settlement. Each stage changes, which forms of value remain usable. This framework matters because most analyses collapse these stages into one. They talk about collapse as if it arrives fully formed. In reality, the system degrades in layers, and value migrates at each layer. The earliest bank freezes were not dramatic. During the Great Depression, banks did not fail all at once. They closed temporarily, reopened with limits, and quietly rewrote the relationship between depositors and their money. Withdrawals were capped, access was delayed, and ownership became conditional on regulatory discretion. Deposits still existed on paper. Their usability did not. This is the part most analyses miss. The failure was not the destruction of money. It was the destruction of immediacy. Cash became valuable not because it appreciated, but because it could still move. But even cash did not survive indefinitely as access tightened. As controls expanded, cash holdings were scrutinized, limited, and sometimes criminalized. Value that could not justify itself inside the system became suspect. The mechanism at work was counterparty risk, revealing itself too late. A bank deposit is a promise, not an object. As long as the institution can honor that promise, it feels identical to ownership. When the institution freezes, the distinction becomes structural. Similar patterns appeared decades later in Argentina. Bank accounts were not erased, they were redefined. Withdrawals were limited, conversions were forced, and legal ownership remained, while economic control vanished. People still had balances. They simply could not use them when it mattered. That means access mattered more than nominal value. By the time this was visible to the public, the outcome was already set. Attempts to protect savings after a freeze begins tend to fail because the hierarchy has already shifted. Assets that require institutional permission to move lose priority. Assets that depend on legal enforcement lose speed. Assets that rely on trust in future settlement lose relevance. This is not a moral judgment. It is an operational one. Modern parallels exist even in highly developed systems. During recent banking stress events, withdrawals were delayed, transfers were questioned, and transaction limits appeared overnight. Official messaging emphasized stability. Operational reality emphasized control. Nothing collapsed, yet something changed. For a brief window, money was no longer purely yours to command. This is easy to overlook because the system resumed. But freezes rarely announce themselves as permanent. They present as temporary measures that reveal permanent incentives. At this stage of the analysis, no asset has been named. That is intentional. The framework comes first because without it, examples mislead. What survives is not determined by price charts or historical averages. It is determined by where an asset sits in the hierarchy of access when institutional motion stops. Understanding that hierarchy requires going deeper into what consistently fails when banks freeze. That exploration cannot be rushed because the failures are quieter than the collapses that follow. When banks freeze, the first assumption that fails is that money is neutral. In stable periods, a dollar in one place behaves like a dollar in another. During freezes, location becomes destiny. Assets embedded inside the banking system inherit its constraints, regardless of their stated value. This is not a flaw. It is how the system is designed to behave under stress. Liquidity is not an inherent property of an asset. It is a permission granted by institutions that can revoke it when survival requires triage. That revocation rarely looks like confiscation. It looks like process. Settlement delays extend, compliance checks multiply, and access is framed as a technical issue rather than a restriction. The effect is the same. Value becomes conditional. This distinction matters because most people evaluate assets by how they perform in markets, not how they function in shutdowns. Markets assume continuous clearing. Freezes break that assumption. During the 2008 financial crisis, interbank lending did not collapse because assets disappeared. It collapsed because no institution trusted another to settle tomorrow what was agreed today. Even solvent entities hoarded liquidity because future access was uncertain. The system did not lack value. It lacked confidence in continuity. Central banks responded by flooding markets with reserves that restored motion, but it also revealed something deeper. The system could only function when a single actor absorbed counterparty risk for everyone else. In those moments, private assets quietly became public dependencies. This pattern repeats across crises. In Cyprus, deposits above a threshold were converted into equity. In Greece, withdrawals were rationed while balances remained visible on screens. In each case, ownership was acknowledged while control was suspended. That separation is the defining feature of bank freezes. The underlying mechanism is balance sheet protection. When institutions face solvency or liquidity stress, they prioritize preserving themselves over honoring immediacy. They do this not out of malice, but out of mandate. Regulators reinforce this behavior because systemic stability outweighs individual access. From the system's perspective, freezing is stabilization. From the individual's perspective, it is a reordering of rights. This reordering exposes the difference between claims and possession. A bank deposit is a claim on an institution. A bond is a claim on future payments. An insurance policy is a claim on future coverage. When the system freezes, claims queue up behind survival. Possession, when it exists, bypasses the queue. But possession alone is not sufficient. History shows that portable assets can still fail if they lose recognition. During periods of extreme stress, governments redefine what is acceptable for settlement. Gold has survived some freezes and failed in others. Foreign currency has functioned as refuge in some cases and been criminalized in others. The variable is not the asset's material. It is whether the system continues to recognize it as legitimate exchange. This is the part most discussions avoid because it resists simple prescriptions. There is no asset that universally survives all freezes. There are only assets that survive specific stages of constraint. That is why the framework matters. In early freezes, speed matters more than legality. In later freezes, legality matters more than speed. Eventually, only assets aligned with state priorities remain liquid. This progression explains why late responses tend to underperform. By the time controls are visible, the acceptable universe has already narrowed. Attempts to move value after restrictions often result in forced conversions, penalties, or outright blockage. The window that matters is earlier, when trust is eroding but motion still exists. Modern systems add a new layer of fragility. Digital finance increases efficiency in normal times but centralizes failure modes. Payment apps, online banks, and brokerage platforms rely on the same settlement rails. When those rails freeze, diversity of interface does not equal diversity of access. Multiple apps connected to the same backend fail together. This gives the illusion of choice without the reality of redundancy. Recent payment outages demonstrate this dynamic in miniature. Balances remain visible, transactions fail. Customer service scripts repeat reassurance, while access remains suspended. These are rehearsals, not accidents. They show how quickly normality depends on uninterrupted infrastructure. The risk is not that banks will fail constantly. The risk is that, when they do pause, the pause changes behavior permanently. Once people experience restricted access, trust erodes asymmetrically. Institutions recover faster than individuals. This asymmetry drives capital flight, hoarding, and alternative settlement networks. But those alternatives face their own constraints, which become visible only under pressure. At this point in the analysis, the question shifts. Not what keeps value in theory, what continues to function when trust, permission, and recognition are all under negotiation. Answering that requires examining not just what survives, but what consistently fails. Because failure patterns are more stable than success stories, and they reveal the incentives that govern the system when stability is no longer the priority. What fails during bank freezes is not random. It follows incentives with mechanical consistency. The first category to break is anything that depends on continuous intermediation. Brokerage accounts, money market funds, and structured products all assume that someone else will make markets, clear trades, and honor redemption schedules. When those intermediaries retreat, the asset does not disappear, its exit does. In 2008, money market funds famously broke the buck, not because the underlying assets went to zero, but because redemption pressure exceeded what the structure could process. The promise of daily liquidity turned out to be conditional on calm. Once that condition vanished, the structure froze. This pattern has repeated in quieter ways since. Funds gate withdrawals, platforms suspend trading, terms of service expand to cover extraordinary circumstances. The language is legal. The impact is practical. Another category that fails is leverage. Leverage performs invisibly in stable periods. It magnifies gains without demanding attention. During freezes, leverage becomes a liability multiplier. Margin calls arrive precisely when liquidity vanishes. Assets that look solvent on paper are liquidated because timing, not value, becomes decisive. This is why highly sophisticated portfolios often perform worse than simple ones in crises. Complexity introduces dependencies. Dependencies break. Real estate offers a useful case study. Property is often described as a store of value. In inflationary periods, that can be true over long horizons. During freezes, real estate becomes illiquid precisely when liquidity is needed. Transactions halt, financing disappears, and taxes continue, regardless of cash flow. Ownership remains. Usability collapses. This is not a critique of property as an asset. It is a clarification of its position in the hierarchy. Real estate survives freezes in accounting terms, not operational ones. Another failure mode emerges in foreign assets held through domestic institutions. International diversification assumes frictionless access across borders. Capital controls reveal the flaw in that assumption. Assets held abroad but custodied locally inherit local restrictions. Assets held locally but denominated abroad face conversion risk. In both cases, jurisdiction overrides denomination. History shows this repeatedly. In times of stress, governments assert control where they can, not where theory says they should. This is the reality framing that rarely appears in official narratives. Contracts are enforced until enforcement threatens stability. Then priorities shift. At the center of all these failures is counterparty risk. In normal times, counterparty risk is abstract. During freezes, it becomes the dominant variable. Every promise is evaluated not by its terms, but by the survival prospects of the promiser. This is why trust collapses unevenly. Large institutions are supported, small ones are sacrificed. Individuals absorb the residual risk. The system behaves exactly as designed, even if that design is rarely acknowledged. Modern digital assets introduce additional complexity. Some were explicitly designed to remove intermediaries. Others simply repackage them behind new interfaces. During stress, the difference becomes visible. Platforms that require centralized custody or compliance checks freeze alongside banks. Assets that can move independently still face choke points at conversion and recognition. This is not a technological failure, it is a governance one. Value that cannot integrate with the existing order struggles to remain liquid. Value that integrates to deeply inherits systemic fragility. There is no neutral position. This tension explains why narratives around safety often lag reality. By the time an asset is widely understood as protective, it has already been absorbed into the system it was meant to hedge. That absorption changes its behavior under stress. Gold held in vaults behaves differently from gold represented by certificates. Cash held privately behaves differently from cash held digitally. The difference is not philosophical, it is procedural. Procedures determine access when discretion replaces rules. At this stage, the framework reveals its shape. Value during bank freezes is not binary, it degrades through stages. Early on, mobility matters, then recognition matters. Finally, alignment with authority matters. Assets move down or up the hierarchy based on how they interact with these constraints. This hierarchy is dynamic. An asset that functions well in one stage may fail in the next. This is why simplistic answers persist and disappoint. They freeze the hierarchy at a single moment. Financial forensics takes a different approach. It studies how assets behave as conditions deteriorate, not just at endpoints. The goal is not to find invincible instruments, it is to understand pathways of failure and survival. That understanding is what allows calm decision-making under pressure. Without it, responses become reactive. Reactivity is punished in freezes. Because the system moves faster than individuals once constraints tighten, the remaining analysis must bring this framework forward into the present. Not to predict outcomes, but to identify signals, incentives, and constraints that shape how future freezes would likely unfold. Only then can practical understanding emerge without false certainty. The present moment does not announce itself as fragile. That is precisely what makes it dangerous. Systems that are visibly unstable invite caution, while systems that appear resilient invite complacency. Today's financial architecture projects strength through scale, coordination, and technical sophistication. Those same qualities concentrate failure when coordination breaks. Central banks have expanded their role from lenders of last resort to market makers of first resort. This has stabilized prices, but not incentives. Institutions now operate with the expectation that freezes will be managed, not avoided. That expectation shapes behavior long before stress appears. Liquidity is optimized for efficiency, not resilience. Buffers are minimized because holding idle capacity is penalized in competitive environments. This works until it does not. When volatility rises, everyone reaches for the same exits. Those exits narrow faster than pricing models anticipate. This is not speculation. It is observable in recent stress events where liquidity vanished in assets previously considered deep and safe. Government bonds briefly malfunctioned. Currency markets required intervention. These were not fringe instruments, they were core plumbing. The mechanism is straightforward. When balance sheets are full and leverage is embedded across the system, small shocks propagate non-linearly. Intermediation becomes a bottleneck. Clearinghouses, custodians, and settlement agents become points of failure. When they pause, everything upstream pauses with them. The freeze is systemic, not localized. Digitalization intensifies this dynamic. Settlement cycles have shortened, but dependency chains have lengthened. Assets move faster, but only along predefined rails. When a rail is blocked, there is no detour. This creates a false sense of liquidity. Speed masks fragility. The illusion persists until the first interruption. Recent episodes of payment outages and transaction backlogs illustrate this fragility in controlled environments. They are resolved quickly, so they are dismissed. But the behavior is instructive. Access can vanish without warning. Restoration depends on centralized decisions. Users have no recourse during the gap. This is the behavioral template for larger freezes. Global debt levels add another layer. High debt is manageable when refinancing is continuous. Freezes interrupt refinancing. That forces prioritization. Who gets paid now versus later becomes a political and institutional decision. Legal frameworks exist, but discretion fills the gaps. This is where hierarchy asserts itself. Sovereign obligations are protected. Systemically important institutions are supported. Everything else negotiates. For individuals, this means that legal ownership is not the same as functional priority. Accounts can exist while access is delayed. Assets can be valued while transactions are suspended. This duality is uncomfortable because it contradicts everyday experience, but it is consistent with history. From post-war Europe to late 20th century emerging markets, freezes reorganized economic life around priority rather than ownership. Black markets did not emerge because people rejected legality. They emerged because legality could not supply continuity. This distinction matters for modern observers. Alternative systems are often framed as ideological choices. In practice, they emerge as operational responses. People gravitate toward whatever settles reliably within constraints. Reliability is situational. It changes as rules change. This brings the analysis to an uncomfortable point. Preparation is less about choosing the right asset and more about understanding when an asset's rules change. Assets do not fail all at once. They fail when the system reclassifies them. Classification happens quietly through regulation, enforcement, and infrastructure decisions. By the time it is publicly acknowledged, adaptation windows have closed. This is why signals matter more than forecasts. Signals include rising emphasis on compliance, expanded emergency powers, and normalization of transaction monitoring. Individually, these appear benign. Collectively, they indicate tightening control over financial motion. Control is not inherently negative. It becomes consequential when motion is restricted selectively. The framework developed earlier applies cleanly here. Early-stage stress rewards mobility. Mid-stage stress rewards recognition. Late-stage stress rewards alignment. The current environment sits uncomfortably between stages. Mobility exists but is conditional. Recognition is broad but revocable. Alignment incentives are becoming clearer. This does not imply imminent crisis. It implies narrowing optionality. Understanding this allows for calm positioning without urgency. The goal is not to outrun a freeze. It is to avoid being surprised by it. The remaining work is synthesis, not a list of instructions, a way of seeing that integrates history, mechanism, and present structure. That synthesis must return to the opening scene. Because the person standing outside the bank is not confused about value, they are confused about access. And access, more than price, is what this entire analysis has been about. The synthesis begins by stripping away labels. What keeps value when banks freeze is not an asset class, a ticker, or a technology. It is a position within the system's hierarchy at the moment motion stops. That hierarchy is built on three variables that recur across history: access, recognition, and alignment. Access determines whether value can be used immediately. Recognition determines whether value is accepted as legitimate settlement. Alignment determines whether value is protected or restricted by authority. Every asset occupies a different position along these dimensions, and that position is not fixed. It shifts as constraints tighten. This is why certainty is dangerous. An asset that functions in early stress can fail later, not because it was flawed, but because the rules around it changed. Understanding this reframes preparation. It moves the focus away from searching for permanent shelters and toward understanding phases. In functional terms, survival is about optionality before the freeze, not heroics after it. History reinforces this relentlessly. Those who preserved value were rarely those who predicted collapse precisely. They were those who understood how systems behave under strain and positioned themselves earlier, quietly, without urgency. They did not wait for confirmation. They watched incentives. They paid attention to how institutions talked about risk, not what they promised. They noticed when access became conditional long before it disappeared. This is not a call to abandon institutions. Institutions are unavoidable. It is a call to understand how deeply one's value is embedded in them. The deeper the embedding, the more one inherits systemic decisions. Shallower embedding increases independence, but introduces other risks, including legitimacy and enforcement. There is no perfect balance. There is only conscious trade-off. This is why simplistic advice fails. It ignores trade-offs. It assumes a static world. Financial forensics rejects that assumption. It treats systems as adaptive organisms under stress. In that view, value is not destroyed in freezes. It is rerouted. Those rerouting decisions reveal priorities. Priorities reveal power. Power determines outcomes. At the practical level, this understanding produces restraint rather than action. It discourages last-minute moves. It discourages concentration in any single dependency. It encourages awareness of where permissions come from and how quickly they can be withdrawn. It encourages respect for boring details like custody, jurisdiction, and settlement mechanics. These details do not matter until they matter completely. This is the calm, actionable understanding that emerges without guarantees, not what to buy, not what to sell, but how to think about value when continuity is no longer assumed. The analysis now returns to the opening scene. The line outside the bank has grown longer. Some people leave, convinced it will resolve. Others stay because leaving feels like surrender. Inside, systems are still unavailable. Employees repeat the same phrases. None of this feels like collapse. It feels procedural. But for those standing there, something has already changed. Their money still exists. Their access does not. Through the framework developed here, this moment becomes legible. The bank did not fail. The hierarchy shifted. Access moved ahead of ownership. Control moved ahead of price. Those who understood that before this morning are not calmer because they are smarter. They are calmer because they are less surprised. They understood that when banks freeze, value does not ask what it is worth. It asks where it sits. And in that quiet reordering, the difference between survival and loss is rarely dramatic. It is structural.